Good morning, stock investors. Welcome to the Monday morning live stream. I am Victor, and I'm joined by Daryl. How you doing this morning, Daryl?
I'm doing wonderful, Victor. It's good to be here.
It is great to be here. We're in mid-November. We had a rough last week. We had some days where it got a little sketchy. Stocks were behaving like we were going to be selling off. But this market, it's got a pretty tough chin. Using a boxing metaphor, it takes a punch and it just stands right back up and fights back. And we saw, especially on Friday, intraday, I saw the market dropped and then it rose. And I'm like, man, this market, it just doesn't quit. Having said that, it was still a negative week for tech stocks. And I think there's a little bit of fear out there, a little bit of concern that stock prices are too high. And even though these businesses are terrific businesses, businesses that are going to do well, there is such a thing as a asset being priced too high. And investors got a little queasy. They were like, maybe I do take a profit here or there. I think a famous I think it's Japanese, right? SoftBank, is that a Japanese
I
investor?
think so.
They got out of Nvidia. And I know that it was just one news story, but that's a pretty smart investor. And that's an investor that takes chances. So if they're getting out of Nvidia, that's interesting. So
I
how
think
did you read last week's action, Daryl?
I think they have to free up some cash for their other commitments that they made. So I didn't consider that one too devastating for Nvidia. I did see some other 13Fs where people started moving out of Nvidia. Collectively, that might be a bit concerning. So as far as the markets overall, I am seeing the put call equity ratio still increasing slightly. The raw data showed a little bit of a decrease on Friday, but the 5-day moving average is still crawling higher and is higher than it has been since September the 16th.
Can you explain the put call ratio and what it signals? If it's moving in a particular direction, is it bullish for stocks or bearish?
Um, it depends on whether people are buying calls or buying puts. So if people are bullish, then they tend to buy calls because they think the market's going up. When that put call ratio gets too skewed,
And when you buy
uh,
puts, you're thinking the stock's going to drop.
yeah, but they normally do that like at the highs, which is somewhat interesting. So when it peaks out, then you can uh, kind of say that we've reached a bottom. So if
Mm-hmm.
you want to show my screen, it'll probably be a little
Yeah,
easier to
let's do it.
explain.
Go ahead.
So you can see when the put call ratio right here, when it got to the peak, we were at the bottom of the market. Then we actually increased. The put call ratio came down and then it peaked again when it started falling. And one day later, we were at the bottom of the market. You can see right here when the put call ratio peaked out, it took one day, we were at the bottom of the market and then continued on the run. On the 10th of October, with that big drop, the put call ratio shot up, but that was the bottom once again. So we are starting to creep back up, which gives me some confidence that, like this 50-day moving average that we closed below, we didn't close below it. Intraday, it traded below it, but it still is holding. And I think I said last Wednesday that I expect this 50-day support line to hold. And given the fact that the put call ratio is also increasing, gives me a little bit of confidence that I don't guess it's a prediction, but that the 50-day would hold. Gives me some confidence that that might be true.
Got it. Okay. So that is interesting. As we approach NVIDIA earnings, it should be a big afternoon on Wednesday when we see NVIDIA announce their earnings. I think as we approach NVIDIA's earnings, it's going to be likely that NVIDIA exceeds the expectations that Wall Street's putting on it. But some stocks have been reporting good numbers and then their stocks prices fall. What's going to happen with NVIDIA? I can't tell you. I'll tell you late on Wednesday, I guess. But I would not be surprised if NVIDIA announces and the stock price goes down. One thing I've observed on NVIDIA is they've put in a lot of stories like between earnings reports. You got, geez, I don't even know which story to start on, but they have a lot of stories where there's, hey, they're investing in this one company and then they're going to buy a bunch of GPUs and so is going to buy a bunch of GPUs. So how many more stories are they going to have on Wednesday that is going to create the excitement for the stock? I don't know. If they don't have any stories, I'd probably guess that the stock's going to trade lower. But we'll have to get there to Wednesday and just watch the earnings and see how the market behaves. But it'll be an exciting week. Any expectations on where the earnings for NVIDIA are going to go? And what do
Well,
you think is going to happen?
we can look at the chart if you want.
Yeah, let's do that.
So they reported around the 27th of January. The RSI the day before was actually pretty high. It was above the midpoint of 50,
Mm-hmm.
and they actually sold off. Then in January we had the DeepSeek issue.
Mm-hmm.
Once again, the RSI was above the 50 point. We closed down 16%. The RSI sunk down. Here they reported the RSI was almost at 70 and they pulled back. So what I'm seeing this time is they did run up, but they pulled back over the last couple of weeks. The RSI had peaked out just before the October 10th sell-off, and we came back down to about the 50 line. We rose up again and surpassed that previous peak, which was really good news. And what we've done is we pulled back to an RSI below 50. I think that sets us up pretty well. The reason I kept mentioning the RSI is it was high during the last 3 earnings. So it had run up before the earnings. This time it is selling off before the earnings. And we have had a recent surge in the RSI, and the price was just at all-time highs on the 29th of October. So I think it's setting up really nice to actually have a price rise if they do have good news in their report.
Oh man. So NVIDIA to 5 trillion or 6 trillion?
Yeah.
Do we round up to 5 trillion or do we round up to 6 trillion?
I think it'll be close to the 204, 208 price by the end of the year. So that'll put them close to 5.
Amazing. Amazing. Yeah, NVIDIA's certainly been super amazing. And, the other story around that is company stocks, especially Meta, have been punished since their earnings. And in their earnings, they announced, hey, we are spending a lot of money in the data center. We don't want to be left behind. It's risky that we're going to spend too much and then we're going to have a low return on invested capital ratio. But it's also risky to fall behind and then you can never catch up. So the response, the stock market's been selling off Meta like quite fast. Meta's been in a real fast fall. And I think that that's going to influence, I think, companies into watching their capital spend, right? Look at this fall from $751 per share down to $609 and falling. So Meta is producing terrific numbers. You look at their quarterly, amazing, 26.25. I was in a Best Buy yesterday buying something for home, and at the very front of the store, they have this Meta glasses kind of big footprint there. And I'm like, huh. Because I'd noticed them at my optometrist too. And I went over there and I had a 2-minute interview of, they were pretty busy, so I didn't want to take too much of their time. I said, hey, how are these Meta glasses taking off? And he's like, oh, it's been awesome. You can't get them right now. You basically get on a wait list. I'm like, that sounds pretty successful. And I thought there was like one style of the glasses. No, they had like 50 to 75 styles, including very sporty, kind of Oakley looking glasses. They had, of course, the Ray-Ban look, and they had other looks. And the cameras are quite hidden. You can't really notice them. Like the first generation, you could totally see the cameras. Now you can't really notice them. So Meta's got a lot of things going right. High revenue growth, terrific margins, but the market is concerned about capital expense. So like Meta, it's kind of like, bringing in that pupil into the principal's office. Didn't she get in trouble a couple of years ago for, doing something wrong on campus? Yeah. I thought you said you weren't going to do it anymore. Yeah, I did say that. Look at your CapEx number, Meta. Didn't you get in trouble back in 2022 when you were spending on the metaverse, just going crazy on it? And we made you go to detention, for 2 weeks in a row. And Meta was like, yeah, I do remember that. Well, here you are spending $18.8 billion in one quarter, 16.5 in a previous quarter. You're going to spend $75 billion on CapEx. That's like alarming. Even though you're killing it on revenue, just smashing your revenue line. So either Mark Zuckerberg is highly talented, genius level kind of guy. And the genius is either going to cook up like a way for Meta to double its value, just become super successful with its CapEx investment, or it's going to haunt the stock and it's going to haunt the company. it's a long way of saying that I think if Meta cannot get a decent return on investment from AI, I don't know that the average corporation stands a chance. Meta is one of the smartest companies on the planet. They know what they're doing. And if they cannot deliver evidence of, hey, we spent all this money on AI and look what we got. It's kind of like the Meta glasses. They're in the store. They're right there in front of me. I'm like, wow, amazed. So these things have cameras. On one of the lenses, they were telling me, and I didn't take the demo. I got to go back and see the demo. It'll have a screen. You can have somebody speaking in one language right in front of you, and it'll give you a it'll interpret and show you the words that they're speaking right in front of you. Okay, cool. You can invoke an AI engine so you can look at things and say, hey, what brand of car is that? Or what kind of this or that, or whatever question you have. That's pretty cool. So I think it's interesting. We're in an interesting time where AI is going to be something. It's going to be something substantial, fundamental, I think, in our whole computing lives, right? Now everybody carries a smartphone. Everybody's got a data signal. Everybody can look at the stock market from anywhere they have a data signal, whether you're in a Starbucks or you're at home or you're on the subway. Hopefully you're not driving behind the wheel and checking your stocks unless you have a fully autonomous car, which we're going to get to some point. And I think AI is going to be a substantial part of our lives, but we're investors. And at what point is the investment worth having? And I lived through the dot-com bubble and could tell you I invested too early on a couple stocks. I took chances. It didn't work out. In general, it did not work out. Now, I did get quite informed and made money over the following 10, 20 years, knowing which businesses were strong and which ones were weak and which ideas were real and which ideas were not real. But this time around, I'm playing it safer and I'm betting the long game by buying Google and Amazon as an example. They're going to win. No matter what happens, Amazon and Google, they're going to win. And I could substantiate that comment. So we are in an interesting time, but let's always remind ourselves that we are stock investors. We're investors in companies, and I think all of us would sign up for. I'd rather buy a business at a really good discount versus overpaying for them, and then watching my investment go down in value. So those are some opening comments. So we covered a couple pieces, but haven't covered the Federal Reserve. What's your feeling on a rate cut? Is a rate cut coming December? 25 basis points, 50, 0. What's the Darrell barometer telling us?
Well, I use the Fed Watch tool. Let's see. This is for December the 10th. And the chances of a rate cut have dropped from 88% 1 month ago, 66% 1 week ago, and currently we're sitting at 44%. So the market is betting that December is skipped. We are going to get some, I think it's labor data this week for the first time since the government shutdown. Let me see. That's on the 20th. Yeah, it will be the non-farm payrolls. It'll be the first time that we've gotten that report since September. So I don't know how that's going to influence them. But in January, the the chances are even below 48. I guess in aggregate, they are above 50. So maybe in January, let's look at the aggregate here. So January, they still have a rate cut. The market is anticipating a rate cut, and then the next one in April. So it doesn't look like one for December, and that's hurting small caps and anyone that is dependent on borrowing against that 10-year rate, REITs and what have you. They're all feeling it right now.
Right. So I heard it, we had a shutdown, so the amount of economic data for us to review has been limited, but I think a private entity, I forgot the name of them, they claimed that in October they saw the highest number of basically layoffs that they'd
Yeah,
seen
that's
in like
the
20
Challenger
years.
report.
How do you process that? Does that help or hurt the rate cut probability?
If they do, I think the way that particular report is, it's not the total number of cuts, but it's announced cuts. So those aren't confirmed necessarily yet. If I understand that report correctly, I may have to do a little bit more research, but those are announced cuts. And normally companies follow through with announced cuts, so it's probably pretty certain. But so how does it play in? I don't know what the Fed is
Well,
more concerned about at this point, whether it's the jobs market or inflation.
yeah, it um, the the job cuts I think affects sentiment. I don't think the Fed pays close attention to that type of report because they're data dependent. But certainly, like the real estate market has seen some sluggish months. I think the other statistic that did catch my attention is that um, the number of not repos but repossessions of properties. What's the word I'm looking for? So the number of
Foreclosure.
defaults, foreclosures. That's the word. Thank you, sir. So the number of foreclosures popped up, and that shows a stressed household that can't make their mortgage payment. And that is meaningful because, you know, I think most people are like, they'll eat peanut butter and jelly sandwiches for months to make that mortgage payment because that owning that home means so much to them emotionally, to their families, to themselves. It's their property. It's their home. So when they have to go into foreclosure, it's a pretty big deal for that individual household. And if you keep seeing those foreclosures go up, it's gonna hurt the real estate market for sure, but it's gonna really make the general sentiment more negative. And I think the Fed is going to pay attention to that. I think the Fed will be like, "Hey, we gotta do something about it because we don't want to end up with a if you have a housing market that's crashing, oh, that's going to be painful." That's I know that stocks are awesome. Uh, I think a lot of households have stocks, but a majority of the wealth in this country is tied into that household's home, the equity in that home. And if you see a crashing market where somebody's been in a home for 20 years, they're like, cool, I have equity of $300,000. I feel safe. If I retire and I can go on a reverse mortgage or I could sell this home and go retire, or I could help my kids, or whatever that path forward looks like for that family. As soon as you see falling real estate prices, man, you want to talk about people freaking out, and they should be. That's a big loss of wealth in households. So that was interesting to see. Did you catch that foreclosure number this past week?
I heard it reported last week. I didn't pay that much attention to it, but I did hear that number.
Real estate prices in California have been insane for 15 years. And you think about 20, I guess they haven't been insane for 15 years. They've been insane for about 8. In 2010, when I was investing in real estate because I thought the market's wrong, and I bought investment properties, I had my choice. I could go into an area and there was 10 homes that I was looking at, and which one was the best one? Which one would I get the best terms on? I bought one property from a bank that was like had repossessed the property. The buying was great. And not too long after that big area of pain, I mean, massive pain. So many people lost a majority of their net worth when the stock market slammed down in 2008, 2009, 2010. Just about nobody wanted to buy real estate. And it was very, very painful. It caused the government to bring in all these new rules to make sure these banks could support themselves. And 10 years after the fact, hey, let's get back in the casino. Let's buy properties at these really incredible high prices. I did some light searching for real estate. I keep thinking to myself, I want to buy more real estate. The buying is good. And I hear some of this negative news, and I look at the prices for homes, and I'm like, you have to pay $1 million in a good part of Southern California, but it's not a great part. It's not like, whoa, you're living, on the sand, on the beach kind of location. No, it's a decent place. And you have to pay $1 million for like a 3-bedroom home. Your mortgage payment on that is huge. I'm like, who could afford that? Where's the next buyer coming from? And this is, how did we get here? It's like buyers kind of like forget to be rational. They forget to be sensible and kind of like look at it, a real estate asset, as an asset. Instead, they're like, man, we will not get outbid. We're going to buy. And you drive up home prices. Now, it's nobody's individual fault. It's just the market. The market is what it is. But it is amazing how quickly we forgot. I could tell you, if we get into a negative mode on real estate, then you're going to really see the pain appear. So, all right, enough said there. Any other comments before we jump into looking at some stocks?
Nope, I'm ready to go.
We've got a new participant on our streams. Paulito, how you doing, man? He wants to look at Dash. I've got Dash on the list. I've got a couple of others on the list. We got NBR, YMM, Zim, eToro. We got a bunch of members on. We got Paul. How you doing, Paul? The SPX has been green 10 of the last 10 Mondays. Will this streak end today? Daryl, what are your thoughts? Are we going to keep the streak alive?
Oh, man. Let's see. Let me go back to my chart and see what I think here. I think we'll end the day higher than we closed on Friday.
All right. You be the optimist. I'm saying we're going to go lower. Sorry,
okay.
Paul. We're going lower today. And right now, The futures are pointing lower. I think we're rolling into the week with some concerns around stock prices. Tomas, it was great talking with you yesterday on the investor call. We'll take a look at eToro, see what's going on there. Mike, I got a good laugh from your statement. I don't know what next physical AI product's going to come out that would interpret the words that you would be saying and have the person that's in front of you hear them in their native language. But who knows? Maybe that's around the corner. Kurt, good to see you this morning. We've got Zim on the list. Benton, we've got NBR, YMM on the list. Thanks everybody for joining, and thanks for the super chat out there. Let's get into a couple of stocks. We're going to get into Dash, and then we're going to get into a couple of stocks that I thought were interesting. One of them being Berkshire Hathaway. They announced they had their annual meeting. They released their 13F filings. They're buying Google. I think it'd be interesting to take a look at Berkshire, but we'll take a look at that later. For now, let's take a look at DoorDash. Dash was a stock that I was an investor in, and I am a happy camper. I made money on Dash. Dash is kind of a single services type company. They do food delivery. They do a variety of deliveries, but mainly food. They're winning the market share battle with Uber Eats and anybody else. But I think their focus is a strength, but could be a weakness because they don't have anything else to lean on. We have a recession. Would that hurt them? That's why I sold the stock after the stock delivered really good returns. And then I saw the stock go higher, but now it's lower. So I guess it was a good move on my part. When we look at this company, it's a high growth company, and I do have a valuation on Dash. So, and what I'll do is I'll compare it to Uber as we go through this particular segment. It's trading lower. We opened on the stock market. It's trading a little lower. Market cap, $89 billion. Imagine that, a food delivery company. And just to kind of rationalize that number, DoorDash delivers for the likes of like Taco Bell. DoorDash has probably a higher market cap than Taco Bell. They have a higher market cap for sure versus others like Jack in the Box, or most restaurants have a lower market cap. McDonald's is the exception. McDonald's is like 200 some odd billion. Forward PE looks really expensive, 108, but I'm sorry, the current PE looks expensive, but the forward PE 34. I know their growth, so that looks rational because of their growth. Analysts think we now are seeing a discounted stock. I agree with them. When we look at Dash, we got 33 analysts weighing in. Every analyst has a price target above its current stock price. So that big drop in the stock price, it was a reaction. The market reacted to something. And you see their growth rate. We're going to see a lot of green coming out of DoorDash. And I think the consumer is really using DoorDash. My sons, especially the younger one, he's 21. I don't think he's ever, the best he's going to learn how to cook is toast. And that's about it, because he DoorDashes everything. It's like he loves the experience. He's like, and good for him. Good for him. See, the older son, he also DoorDashes, but not as much. He cooks a little bit on his own. All right, so earnings per share. Looking good, growing at 65%, 49%, 68%. These numbers look awesome. High growth, getting to be a $24 billion market cap company. And they have really good margins. They don't cook any food. They just operate a platform where gig workers will deliver food. genius. This is a new segment of our economy. This kind of existed in the past where 30 years ago, yeah, you got pizza being delivered, maybe some Chinese food is being delivered, but it was very one off. It was very fragmented. Now DoorDash is like, hey, whether you want a cheeseburger or you want $100 meal, we'll deliver it to you. And just go on the app. You can have a subscription, then you get better pricing on your deliveries. That whole thing, they're really good at it. So overall, I like the business. And let's take a look at the valuation I have for DoorDash. Then we're going to compare it to Uber, see what's going on with Uber. And what's going to be really important is Daryl's section, which is what's he seen on the charts, because DoorDash, so the DoorDash discount rate, I don't know that it should be 9. Okay, so let me update a few things here. I haven't updated DoorDash, so let's update that together on the fly, and then we can get to the most recent valuation on this company. So the free cash flow for the trailing 12 months is 2,229,000. That number is growing nicely. And I'm going to update that to okay. And then what kind of cash do we have on the balance sheet? $4,240,000,000. They do have some debt. Okay. And then what kind of earnings per share do I expect in 2026? And the number that the analysts believe they're going to come in with is $4.19. I think they deserve a high PE. So DoorDash has a 21% discount. Now, is that discount floating my boat? No, because there's a force in the universe that is a threat to DoorDash. And that force is Uber. Uber does do food delivery. Now, if we just looked at food delivery, I would say DoorDash is better. I think they're better. Uber Eats is okay. It's good. But Uber has mobility, ride sharing. They're getting into it. Robotaxi. They even have freight. So a more diversified, stronger, higher cash flow producing, company. It also carries a really, really good discount. So as an investor, I'm going to put more capital into Uber, and I'm not going to get into the Dash. I think Dash was a good investment in my rearview mirror, but the piece that I'm afraid of is they're a one-trick pony. One-trick pony. If, let's say, Uber Eats they start giving it away. They start saying, you know what? If you go on Uber and you take $100 of rides, you get $20 of credit on Uber Eats. Some crazy idea like that. It could really hurt DoorDash. But in general, I'd rather buy Uber versus DoorDash. I like DoorDash. I like what they're doing. From a business operating the business and idea generator, DoorDash has been a really good company. I've been really impressed with their ability to deliver value to the consumer to the point where they're growing the way they're growing. So those are my comments on DoorDash. Let's turn it over to Daryl, who could take a look at the charts and see how this stock's trading, see if it's a good time or a bad time to consider DoorDash.
So on the 6th after their report, they dropped 17.5%. and they have not closed above the high of that day since. So that's 1, 2, 3, 4, 5, 6, 7 days. And it doesn't look like today is going to be their day either. So 7 days they've traded below the high of the day following earnings. The 5-day moving average dropped pretty significantly. It has looks like it's bottomed out, and today it's curling back upwards. The 21-day is still moving downwards. The 50-day is moving downwards. The 200-day looks to still be rising to me, but if it spends a few more days underneath that 200, then you're going to start seeing that roll over. Their RSI was very overbought for about a week. It has moved out of the overbought condition, but it's still sitting at 33, which is pretty low. We really haven't seen a reading like that for the past year. The accumulation also started declining, so we went into distribution mode at these highs here. So one thing you could do is maybe go out a few more years and find some support and resistance, in previous times, and be sure to keep an eye on those. I'm not for sure that it's going to recover anytime soon based on what I saw. So, you do have some support around, looks like about 186, and then about 160. And then your next support level is about 137 or so. So I don't know what to think about this one. I don't see a speedy recovery here.
Yeah, and I like the kind of homework that Paulito's doing on the stock. They're doing auto parts delivery to I guess his shop. And I think DoorDash can open other categories. They're doing that for retail, and auto parts makes a lot of sense, right? You got an auto repair center, and they're like having to get parts from all kinds of different places. Man, they could just have DoorDash get a part from point A to point B. That makes a lot of sense, right? So they can keep growing. Totally get it. But as we invest, we're investing in a market where you can have a comparable stock. And the compare to DoorDash is Uber. And Uber has been performing better over the 1 year, and it's been more stable. You see that DoorDash at times has been, doing better than Uber. On August 7th, it looked pretty darn good. It was ahead of Uber, but then it just really had a bad day. And Uber had a bad day after their earnings as well. They announced good earnings, and then boom, the stock sold off. So I'm seeing that a lot of stocks are showing good numbers, but then the market's like, well, you solved world hunger, but we wanted you to solve world hunger and cancer, So good job on solving world hunger and fantastic numbers, but they weren't fantastic enough. And Uber did sell off. You see the sell off there. But these smaller caps, and I guess my sentiment on DoorDash is also a sentiment maybe that the general investor feels is the case in this market. So those are the choices you got. Is do you want to go with the bigger player that is certainly delivering good results to investors? Do you want to take a chance on DoorDash? You might make more money on DoorDash, but you may also see your investment trail Uber. So that's the work of an investor, looking at the qualitative, the big picture, and saying, which company do I believe in most? Which company do I think is going to outperform? DoorDash has had a month where sold off harshly. Is that an opportunity, or is the market trying to tell me this stock isn't as valuable as we thought 60 days ago? We think they are probably going to see forces in the market that are going to keep it from growing and being as big as they want to be, potentially. Or the market could be wrong, but it's your decision on which is going to happen over the next year to 2 years. Really good stock to get into DoorDash, because it tells us, a lot of things. There's kind of a lesson in DoorDash and Uber is, which player do you pick, the bigger or the smaller? So thanks for asking, Paulito. Please come back. It'd be great to have you. Stick around if you want to see the other stocks that we're going to look at. Before we jump into more stocks, what's going on with this stock market? Look at that. You heard it from Daryl first. The market would be trading higher. Right now, I'm thinking maybe it will trade higher. I'm easily swayed because sometimes I get it wrong. If we look at the 1 day, look at that. It is going to be a good day for Googlers, Google stockholders. The stock is picking up a lot of investors because the great Warren Buffett has decided, you know what? Let's buy into Google. Let's buy $4.3 billion of shares and be a Google stockholder. So the stock's up 5.6%. Beautiful. Very good day for Google. And looks like Broadcom's picking up a bid. NVIDIA is under some pressure. Apple's under some pressure. Berkshire Hathaway, Warren Buffett, also in the 13F filing that I believe was reported on Friday, they put in that they're selling more shares of Apple. And now they only own $60 billion of Apple. Whoa, it's getting light on the shares for Apple. All right, so back on healthcare, we've got some green on the screen. Looks like some pharmaceuticals. If we have some time, I wanted to look at Pfizer and Novo Nordisk. A little voice inside my head keeps telling me, I was listening to another YouTuber over the weekend and looked at, I like listening to other investors, trying to gather their sentiment, their perspective on the market, what they're seeing, what they're liking, not necessarily to copy them, but it's basically what's the theme that might work going forward. And one of the themes that I picked up on is pharmaceutical may really start cleaning up because they make a lot of money. So let's take a look at Novo Nordisk and Pfizer if we have time. Looks like UNH is going higher. We talked about this on the investor call yesterday. We went at length that I think there's been some concerns in this space, but I believe the space is fine. But we'll see how the market believes over the next 6 to 12 months. All right, that is interesting. All right, so let's keep rolling. Let's get into the next stock we're going to look at is going to be NBR. And before I do that, let me look at Paulito's comment here. Second place companies, Paulito, sometimes they are great investments. It's your decision. The qualitative decision you make, it's really important. I like DoorDash. I was a DoorDash investor. I think their business is a good one. And I also love Uber. And it's almost like saying, you got a football team and you got the choice of like 10 quarterbacks. Do you take the quarterback who has 2 Super Bowl wins? He's great physically, gets it done. Or do you take the quarterback with no Super Bowl wins, great physical aspects, terrific player? It's a tough choice, but it's your choice, right? There's probably other factors that weigh into it. And try to follow a process and try to define your process, your recipe for success. And if you define your process, then you'll be able to revisit that process and see, hey, this investment really worked out well. Let me go back to my process. What did I do and how could I do that again across other businesses and make money? Or, hey, I lost money on that stock. Let me go back to my process. What worked? What didn't work? What surprised me? What data did I didn't pay attention to? Was the market trying to tell me something like that big sell-off after they reported earnings? So try to define that process, and it doesn't have to be like 20 pages long. You could just define it as the ingredients to my investing processes A, B, and C, and then follow that. So you can just learn, become better. Each year you become better and make more money. So great to have you. Thank you, sir. We got a new member, and I've noticed Sam. Sam's been a player, a participant. Thanks so much, Sam, for joining. Let's look at 4. We can look at 4. I've never looked at 4. That's a pretty neat little symbol. Thanks again, Sam. All right, let's keep rocking. We're on Nabors Industries. Nabors Industries provides drilling and drilling-related services for land-based and offshore oil, natural gas wells in the U.S. and internationally. So they service the energy sector. Oil company says, hey, you know what? We have the rights to drill in name the territory. And they contract with Nabors and say, I want you to drill wells here and here and here. This is where the geologists are saying we should drill. Perfect. They get out there with their crew, they drill, and they try to extract oil. This is a small cap. These companies make more money when oil prices are expected to rise. What's been happening lately? Oil prices have seen a general bear market. Is this a new IPO, or why am I not getting a chart here? Well, let's go over to Google, see if Google can handle the request. Looks like it can. So this stock, when we were seeing oil prices rise in 2021, 2022, the oil companies were very active in drilling. Hey, we got to drill for more oil. We get more money every barrel we extract. Perfect. Hey, Nabors, get out there. We need you to drill a bunch of wells. And then when oil starts contracting and volumes go down and the per barrel price that they get, that's when they don't see their stock price work because there's not a lot of revenues. But I do notice this activity. I'm going to be curious to see what Daryl has to say because that looks interesting. Now, we have seen a market where oil has been going up, and this is not giving me oil prices, but I know that CNBC does cover it. Oil prices have gone up a little bit, not a lot, $60 per barrel. That's not getting me all that excited. I get excited when it's up, if you own energy companies and per barrel gets up 120, it's like printing money. These oil companies are so profitable. They're like, oh, sweet. Our cost to extract a barrel of oil and get it to market is like $40. And we get 120, and they make a lot of money, and they want companies like Nabors to get out there and drill as fast as they can. So that's a quick overview. This is a small cap. P ratio is tiny. Now, the one thing I would say that is an undesirable about businesses like this is that they are not as profitable as the energy company. If you are Occidental and you get to make money on every barrel of oil. Your cost is pretty defined. When you're a Nabors type of company, your margins, let me see if I could find that line, are not great because you're employing people. An oil company tells you go drill over here, right? And okay, perfect. You get your crew out there. You have to pay these skilled employees. You have to put your equipment out there. You have operating expenses. You have to pay for the fuel you're putting into your trucks and equipment, all that good stuff. So it leaves a smaller gross margin and it leaves you a smaller profit margin. So those are the things that I keep an eye on. We will not see this stock ever like quadruple or maybe 10 bag because they're limited with what kind of profitability they're going to make. Now, this isn't a bad 1 year, 2 year investment where you get in when oil prices are relatively low. If you have an increasing oil price, if that forecast is we're going to have a $90 per barrel price, you're going to see your stock go up to $75, $85 per share. And I personally would exit. I'd be like, okay, it's not going to get any better. It's not going to continue to compound. I'm getting out. That would be how I would invest in a stock like this. You see that their growth is going to be green, but it's not going to be exciting. Next year, it's going to be flat. We need that per barrel price to go up in order to create some more energy activity in this space. So we've got, what kind of cash flow are we dealing with and what kind of debt? Let's go over the debt first. We've got net debt of almost $2 billion, debt to EBITDA 2.57. Not a problem, but there's some debt on the balance sheet. So that's kind of a little bit of a concern. Keep in mind, it's less than $1 billion in market cap, and they're carrying $2 billion of debt. So the debt level is higher than their market cap. That doesn't feel great. Cash flow, they're burning cash at this time. Let's take a look at their historic cash flow. See if maybe that is been if it's been better in the past. So cash flow has been better, especially in those go-go years. They had better cash flows. So I would say that right now, this stock is probably not, they're not receiving a lot of attention. It could be a stock that if you can qualitative big picture, if you think barrel prices are going to go up, you formed that thesis. This is a good idea. Outside of that, I don't know what idea would be out there that would cause me to be interested in Nabors. What do you think about Nabors?
Well, I drew a couple trend lines while you were talking because I had never looked at this company before. So I started with the high we saw on February the 9th, and I see a downtrend that's connected to the September 2023 high. It surpassed it in 30 July of 2024, slightly above it in November of 2024, and then it peaked above it, but is now trading below that downtrend line. So we've been on a downtrend for basically 2 years, and then we're trading sideways for a year. So if we go back to the 1 year chart, I do see this uptrend from the May 22nd low that's connected to the low we saw in August of this year, and then again in October of this year. So we do have a wedge pattern that it's trading inside. It is struggling to get above about $51 or so, and could trade back down to this lower rising trend line. It is finding support at the 20-day. So we had the sell off on November the 12th, and it came down to close to the 20. It touched intraday in the 20-day moving average on the next day. Traded a bit below it the next day, but did close higher. And today I can see that it, we just got an update, and it is trading higher than yesterday and still holding that 20-day moving average. The 50-day is upward sloping. The 200-day is still downward sloping, but looks like it's leveling off a bit. The RSI is sitting at 56. We did get up to a peak RSI on 29th of October, and the price was at $51 or so. It is holding the 40-day, or not 40-day, 40 RSI. So it didn't even come down to the 50 here on that trading day and started moving back up. So for a very short term purchase, this looks like maybe you could make a few bucks in a very short term, but it's fighting this downward trend line at the moment. I would really need to see it break really above that. Let's go back out and just see where some other support or resistance might be. So that this price is actually at the same price we saw in December of 2024. So it served as support here and is serving as resistance here. If it does break out above this downtrend line, the next point of resistance I see is at $57. Maybe between 61 and 67. So if it can break out above that downtrend line, then you've got, looks like about anywhere from $13 to $17 of upside.
Looks good. So again, once oil moves, man, it moves. Stocks will move fast. And it's not a bad idea right now. It's just, you gotta have a handle on where oil is going to go. 1 second. I got text messages and all kinds of stuff coming at me. Sorry about that. All right. So interesting little company. Let's move on to a stock that was requested by our newest member. That is FOR. This is a payment processor. They provision software and payment processing solutions in the US and internationally. And payment processors have not been treated all that great by the stock market. The 5-year, this looks pretty interesting. This is a $6 billion market cap company. I'm an owner in PayPal, and PayPal, for moments it's looked good, for moments it's looked horrible. And this one here looks like it's kind of following suit, so to speak. At certain times, you're like, geez, the market just hates this company. And at times it's like, man, it loves this company. It's like, wow, it's feast or famine. The revenue on the company is 3.88 billion. Very good, price to sales ratio. Forward P looks good at 11.3. Analysts think it's discounted. Analysts believe, all stock analysts, all 21 stock analysts believe a price target above its current stock price is due. which is interesting. It bodes well for the stock. What looks great is this growth in revenue. You have 26% growth in 2026. They have been operating with 29% growth in 2025. That looks terrific. Terrific. They're going to expand their profit. Looks good. And their PE ratio is going to drop to single digits within 2 years. How does a company growing this well drop to single digit PE? The market doesn't like these types of companies. It's like, man, payment processors, hate them. All kidding aside, I'm like, it's been a mystery. I'm like, PayPal makes a lot of money. This company making a lot of money. What's the deal? One story that I've heard, I don't quite believe it all. In fact, let me show my hoodie here. That's the Ethereum symbol, right? I'm a crypto investor. Now, I'm not a crypto expert. I would never claim to be, but I've been investing in crypto since 2017. So the story of stable coins are going to come into the payment space and begin to disrupt payment processors. I don't see it in the next 5 years, maybe in 10 years. Now, I don't invest on what's going to work in 10 years. Okay. I would lose a lot of money. So I think payment processors are fine. I think the business is going to be good for them, but the market hasn't really agreed with that and has been trading these stocks lower. Interesting. They have a little bit of debt on the books, $4.79 billion of debt, $1.5 billion in cash. That is a little bit of a surprise. These guys should have zero debt. Debt to EBITDA. Houston, we have a problem. Why do they have so much debt? That's a problem. Okay. So let's take a look at PayPal, which is a known commodity. And PayPal, what kind of debt you got? 1.4 billion. It's a much bigger company. Debt to EBITDA, 1.8. So debt to EBITDA, what it tells me is it's going to take over 6 years if 4 decided, you know what, we're just going to dedicate all EBITDA earnings before interest, taxes, depreciation, and amortization. We're just going to devote it to bringing down debt. What are you going to use to grow the business? How are you going to compete against PayPal and Block and everybody else that's coming after your space? Well, we're going to have to ignore that because we have so much debt. That's not the company that I want to own. That's a bad position to be in. Now, if they can grow fast and grow into this debt level, that'd be great, but I don't think they're growing that fast. So that is a showstopper for me, folks. And let's take a look at their balance sheet. Maybe there's a misunderstanding and stock analysis is not picking up the right information. So let's go and hear it from the horse's mouth. With AI, we're probably going to get talking horses at some point. All right. So we've got, this is what I want to get to. And we've got, this is the 10Q from Shift. And let's take a look at their balance sheet. So their balance sheet, here's the cash. I'm good. Let's get down to the debt. Long-term debt, $4 billion. What are you doing with $4 billion of debt? What are you doing with it? Let's go to their website. What is it that you do that requires debt? Are they doing buy now, pay later? That could be an explanation. So food and beverage, retail. e-commerce. Got it. Okay. Solutions. So you do point of sale, mobile, solo, point of sale, gift cards, pay with crypto. Okay. Stable coins, online payments. So I'm not seeing buy now, pay later in here. Okay. Which could drive up potentially the borrowed money to get that business off the ground. So that debt level is a showstopper. This would be a sell, do not touch, do not invest. We've got a big problem on our hands situation. And I could do a quick valuation on this while Daryl looks at the charts, and I'll show you how that debt's going to really erode a lot of the value of this business. What are you seeing on the charts for 4?
So because it is trading below the April lows, which makes really no sense in the market that we're currently in. I went back 3 years and just added an auto support resistance line there, trying to connect as many points as I can, showing where support might be. And it is finding support at that particular price, which was the April low. It was a high back in July of 2023. And then because it could easily break down through here, I just went and added another one to the next level of support. And I see more down here. So if this particular stock comes up again, or we see it break through these prices, then we could add some more trend lines or auto support resistance lines. One would be about right there. And then probably right there. So that's why I have those 2 lines there. So now let's go back to a year. We are on a downtrend. So the downtrend line is connected to the high we saw on February the 8th, connected to the high we saw in July, and then stretched out across here. It's trading significantly below that right now, about 27%. It is finding support, although it did break through that support area, but it is trading above it right now. The 5-day is had peaked, it looks like on Friday, and is now trailing downwards with the 1.6, 1.25 or 26% decline today. The RSI has not made it above 50 since before whatever happened on this day right here, maybe earnings. It has not been above 50 since then. That's not terribly good. And we've been in distribution since. So if I draw a line across here, you can see where it's been in distribution since this. I'm presuming this is an earnings date here. And you can also see the negative money flow, which is what this accumulation distribution line is based on. So accumulation distribution is a cumulative total of the money flow. And we have been negative money flow since that date, and which reflects itself in the accumulation distribution as distribution. So it has underperformed the S&P by 40%, underperforming the technology sector by 40%. It's underperforming the software industry group by 36%, and that group is underperforming by 1.61%, the SPY.
Okay. And looking at evaluation of 4. So a couple of things. So I've got it right next to PayPal. PayPal has a decent balance sheet, so I'm going with a discount rate of 7.5. I've shared my concerns around the balance sheet for Shift 4. So I'm going with the discount rate of 10%, which is, this is a higher risk company. So that's warranted. The growth rate on cash flow should be a little higher. I'm going to go with 10% because they are growing really nicely. Probably go, yeah, 10% is good. And the cash flow in the trailing 12 months is decent. And the intrinsic value of all those cash flows that I expect in the future, $8 billion. Add cash and take away that big debt pile. It brings down the equity value to 4.9. So you're looking at a stock that is discounted a little bit. If you look at the cash flow value, discounted at a higher discount rate. And when we look at earnings per share, it's a good number using a very low PE, considering their growth rate, but I'm also considering the balance sheet. It's a discounted stock. So overall, this is a discounted stock. Now, the market doesn't like it. And you can pick up PayPal, which isn't growing as fast, but it's much bigger, in my opinion, at a 59% discount. So Shift 4 is discounted, but man, it's risky. Can this one work? It can, but I'd be amazed if this thing doubled in value over the next 5 years. I think it could actually result in very little to no appreciation over the next 5 years. That would be my comments on 4. Thank you for asking. Thanks for becoming a member. Come back, ask more questions. Great to have you. All right, so let's keep rolling here. What's this stock market doing? I'm seeing messages from Shadow Guy. He took profits on Instacart. Man. Stone cold capitalist taking the money and running on Instacart, which has had a couple nice weeks, by the way. This stock had been under pressure. Stock market has been hating it. But recently it decided, no, actually we like it. Amazon's not going to put them out of business. Of course they're not. These guys do grocery delivery and do it well. So I'm glad I'm an Instacart Maple Bear stockholder. And I'm glad you're making some money, Shadow Guy. Congratulations. All right. So that was Shadow Guy. Good to see you. It looks like, Benton, you've been seeing Shift 4 all over the place. Very good. Yeah. And, the payment space is crowded, competitive, tough. So make sure you look at your investment holistically. All right, let's keep rocking. Another word from this stone cold capitalist. Stone cold capitalist in a no capital gains tax country. Oh, that's super stone cold. Man, just let me dream out loud about taking big gains with no capital gains. That would be something. All right, let's talk about Zim. I think Kurt asked about Zim. Zim shipping. Oh my gosh, what's going on here? They're going to announce on November 20th. Now, the economy seems to be picking up for shipping because I think the whole tariff thing is beginning to lose. If anything, the volume's been turned down and it's beginning to kind of get figured out. It's, the big countries, China, US, are sorting things out. And that might be helping our friends over at Zim, who operate the shipping company that moves many containers from key areas or key ports to other key ports. For example, China to the west coast of the US, China to the east coast, China to Europe, back and forth, and so forth. So these guys have caught a bid. So they're going to release earnings on the 20th. So we are a few days away. The market can't wait to buy the stock. It's buying it up. Wow, what do you suspect, Daryl, is going on here? Earnings in a couple days and the stock's trading higher. Did an insider buy more shares or what? What's going on?
I don't know. Let me see if I can find anything quickly.
Probably some Redditor, some famous Redditors like, oh, I'm buying Zim. Boom. Michael Burry's buying Zim. Boom. Goes up.
Last news I saw reported was on November the 17th.
Exactly.
No, that's today. I'm sorry. November the 3rd. I'm sorry about misquoting. I was looking at my calendar.
I've invested in Zim in the past and made money. So I like Zim. I like stocks that make money for my portfolio. I'm a very easy guy to figure out. PE ratio 1.
I don't see any insider buying or selling since last year.
Let me ask you a question, sir. How many times do you come across a PE ratio of 1?
Not very often.
I don't think I've seen that ever, or I can't remember ever seeing it at 1. That means they're making the same amount of profit as their stock price. That's nuts. That's crazy. So let's get on this crazy path and evaluate Zim. I should have a valuation of these guys. Let's take a look. $2 billion market cap, while the company provides $8.5 billion of revenue. Yep, earnings per share is $16.60. Stock price $17. So that looks really good. So obviously this stock doesn't trade on fundamentals. It's not like you take the P ratio and yada, yada, yada. It trades on what is going to happen in shipping. Is shipping going to flourish? Are the shipping rates going to rise or fall? And that's an important question to answer is how are shipping rates looking? If the rates to move a container go up 25%, these guys make so much money. Some years, Zim has delivered dividends of like 50 to 60% of the stock price. Just crazy amounts of appreciation. The dividend has gone down to 41%. Ha, ha, ha. Look at that. Crazy. All right. Now the stock has given up 33%. It's picked up a bid. Man, this is interesting, huh? Now, back in the COVID days when we had those supply chain constraints and you had volumes exceeding supply, and I remember a shipping container, you normally pay, $1,500, $2,500 to ship a big container. These companies were getting like $15,000. It's like, oh, yeah, the stock really took off. It went up to $80 per share, and then you received your investment back in dividends, like real quick. Crazy. And then the stock cratered, but you could have picked it up, which I did, and make some money. Is it time to pick up some shares in Zim? Well, let's try to see if that's a good idea or a bad one in this particular segment. All right. Analysts say sell it. You don't want this kind of dividend. Think of the tax problems you're going to have making that kind of money. Well, I would like tax problems. Thank you very much. Give me as much money as you're willing to give me, and I'll pay the tax. So let's take a look at the quarterly. The revenue did go down the last quarter, but we've had a lot of green on the screen. Quarters have been pretty green. We've got 4 analysts putting themselves out there saying, man, stay away from Zim. Look out. It's going to cost you money while the stock rallies higher. They also believe revenue is going to come down, that shipping rates are going to go down. Now, do I agree with that? I don't agree with it. And just big picture, right? Got tariff arguing is kind of settling down. we get more volumes. I think shipping rates are going to be fine going forward. Earnings per share look good this year. They're supposed to lose money next year. And one thing that Zim did is they used a lot of that money they made and they modernized their fleet. So their fleet is actually more efficient with fuel. So it makes them more profitable. So I'm going to turn it over to Daryl to help us figure this stock out. It is a hard one to figure out, by the way. I'm curious to see what Daryl's got to say about this one.
Yeah, I haven't really tracked shipping companies since back in 2022 and 2023 when all of that was going on. So you can see their dividends down here. Here was a $17 a share payout, $2 payout. This last one I think looks to be about 6 cents. And the one before that was 75 cents. Then we had a $3.17. So they definitely pay out variable dividends. They've been pretty much trading in a range for the past year and a half. After this big sell off into 2024, these dividends, by the way, if you live in the United States, they have tax withholding on them by 25%. So you don't get all of that $17 dividend unless you do some special request to get that refunded back to you. So keep that in mind. You don't get to keep all of that.
Oh, that's right.
Yep. I've owned them in the past. To me, the best thing to do when they announce is to sell it and then buy it afterwards if you're still interested in it. So they are on quite a run since the 10th of October, the 20 days upward sloping, 50 days upward sloping. 200-day had topped out back in August and was declining. Now it's bottomed out and starting to increase. And like I said, I didn't see any news that's driving this 8% increase today. This money flow and distribution looks pretty terrible to me. They definitely swing to the maximum in the RSI, clear down to the bottom. They do that, looks like several times in the past year. So this is a tough one. You can definitely make money in it, but it's something that has to be babysat pretty well.
I think you need to get in and get out surgically. Like, no, like how I play Zim is and other highly volatile stocks is I invest and I define my exit strategy when I buy. Like, hey, if it goes up 25%, I'm out. 30%, 35%. But I try not to get greedy because for all you know, let's say you said 50%, it goes up 40%, and then it drops. You're like, oh, I could have had a quick win. So that's my approach. And I'm looking at, I asked one of the biggest brains on the planet, which is Gemini, for a forecast, shipping rates, short-term outlook. Elevated rates are expected to remain high. Okay. That's good for Zim. Red Sea disruptions. So there was a oil tanker seized at the Horn of Hormuz or something like that. That's causing a little tension out there. Long-term potential decline, trade volatility, economic headwinds. Okay. That makes sense. All right. So I think shipping rates are in the favor of Zim. See if this site gives us any more information here. Yeah, see the suspension of tariffs. Yeah. Okay. All right. So I have a discount on Zim. It will always be discounted, it seems. It's not about fundamental analysis on this stock. It's about, what do you think is going to happen in the next 3 to 6 months and how will you play it? But I personally would never pick up Zim and say, oh, I'm going to own it for 5 years. Whew, that is going to be a very interesting 5 years, let me tell you. But hey, you know what? I'm going to buy it. And I want one of these little rallies here from 12 to 17. Get out, make some money, done. Cool. I could see that. Now, it's hard to do that on a day when it's just popping up like that. But boy, this one did pop up nicely. Hopefully, Kurt owns this stock and he's sitting there dancing, going, yes, made some money. I made some money in the 1 month, made 28%. I'd be ringing that cash register on this stock. Because this one here, you got to get in and get out, in my opinion. You can make some money, but you got to have your dancing shoes on if you're going to invest in Zim. All right. We got a lot of stuff. Look, Zim brings the comments out of the woodwork. Yeah, the dividend does change drastically based on their profitability. And it looks like Fall's Grave looked at it when the P ratio is 0.85. Woo, crazy. I think they are under book value because their assets are pretty valuable. They own their ships. A couple of things to consider, Tomas, on the dividend. As Daryl mentioned, the Israeli government does grab a piece of that and says, hey, thank you very much for investing in Israel. And we appreciate your success so much that we're going to take a part of it. They grab a piece of your dividend. So that's a part of it. It's still very high. And the volatility, right? If you bought Zim and you held it for a year, you're down on the value of the stock. An investor might say, well, I still got higher dividends than my drop. That's fine. But I just don't like seeing negative numbers. I'd rather see this. I'm after appreciation of stock prices. So, and Benton, yeah, man, Zim, these are fun. Okay, so we got another FRO, another shipping stock. Frontline. Oil tankers. Wow, this is looking good. Wow. This one's been a winner all day long with a dividend. That looks good. There we go. So you can be in shipping and have long-term gains. Let me show you shipping stock, a tiny one that I made a fair amount of money on. My son brought it up yesterday because we were talking about how the shipping lanes up in near the ice cap or the North Pole, global warming is opening up a lot of those shipping lanes. And this company specializes in those northern routes. And these guys, if you bought them at the right time, which I did, you rode this thing sky high. It was a beautiful multi-bagger for me. And I got out at the right time. And I just tipped my hat and said, thank you, Panel. I appreciate the big, giant return, and moved on. I started buying them when they were a $60 million market cap. And I sold them when they were probably around here. So it was a $2 stock when I bought it, and did really well with it. So you could make money with shipping. You just got to study it and understand, you got to get in with the right mindset. We were dealing with COVID back here. We don't have COVID coming for another 100 years, or I guess 96 years. It's 100. Every 100 years we have a pandemic like that. So, all right. That was Zim. Let's keep going. We got a lot of chat going on. Oh, so Cyprus, no dividend. That was a very good move there on this stock. So this stock here, Frontline, it's appreciated nicely. It pays a nice dividend up this year. Everything looks good about this stock. Man, forward P looks good. 3 analysts cover it. Not a lot of coverage, but 9 of them do weigh in, and they believe that they're going to have a good revenue growth. This has just been an absolute success. Beautiful. Thanks for bringing that up. Okay. Somebody asked about eToro. And eToro, it wasn't getting a lot of love ever since its IPO. It IPO'd back in May 14th. And the market's like, yeah, we're not quite sure you guys are good. So recently they announced earnings, and it hasn't been that the company is like operating terribly. It's actually the opposite. Their growth has been really good. Profits. I mean, you look at big picture, they focus on Europe. That's where most of their revenue comes from. Europe's really picking up. The Europe markets are appreciating. A lot of investor activity in Europe. Just a lot of good things form a very positive big picture for eToro. But the stock, ever since it IPO'd, this is why I don't touch IPOs. It's like IPOs surprise me, usually surprise me and cost me money. I don't invest in IPOs. Here's another example. Now I've started investing in eToro because I saw their earnings and I saw their reaction to the market, where the market realized, wait a second, you're telling me that this business, I'm pretending to be the stock market. And if the stock market had a voice, which I'm sure AI is going to eventually get to, this company is really growing its revenues, and it has a very good strategy in Europe, and it's being priced way down. They've had a couple of earnings since they have went IPO. So I'm at a dollar cost average into this stock. They have positive free cash flows. They have profitability. It is a brokerage business. They also do crypto. And I would say they're kind of like Robinhood, but made for Europe. Okay. And I like their story, and I want to make some money on them. So I started a dollar cost average in. With the stock price settling down a little bit, I'm probably going to buy some shares today. Market cap 3.33 billion, revenue of 15.67 billion. P ratio super low, 5.4, moving to 15. So this is a good looking stock. Analysts, they look at the fundamentals and they think it's 60% discounted. They think it's going to keep growing in the future, getting to be a $1 billion revenue business with nice profits and a reasonable price to earnings ratio. That looks good to me. Looks really good, which is why I am dollar cost averaging into eToro. I've done fabulously with Robinhood and Futu over in Asia. I wouldn't mind having a financial services brokerage player in Europe that is making money, growing. Sign me up. It's a small position at this point. I just started it last week. and I'll be adding some shares today. What do you think of eToro, Daryl?
I know the last time we looked at this one, we didn't draw any annotations on the chart, but the fundamental story that you're talking about is probably much stronger than the chart at the moment. Since they IPO'd, except for about the first month, they have not managed to get above a 60 RSI, so the momentum just isn't building there. They dropped below 40 and have probably spent most of their existence in the charts below 40. We do see the accumulation in shares here recently with this recent buy. The last 2 days or 3 days, they actually are trading below what they were seeing. The volume is falling off pretty quickly. So there's not really a whole lot to analyze here, but from a charting perspective, they still look pretty weak to me. So you're definitely buying it on a fundamental story.
Yep, I agree. So that is eToro. I'm going to pick up the pace a little bit. It's been a really good stream. Thanks everybody for tuning in. We've got a lot of people on the stream. Had really good activity. Let's get into INCY, Incyte. Incyte Corporation, a biopharmaceutical company, engages in the discovery, development, and commercialization of therapeutics in the United States, Europe, and Canada and Japan. The company offers Jakafi for the treatment of intermediate and high-risk myelofibrosis, polycythemia, Vera steroid refractory acute graft versus host disease. Whew. Man, I barely survived biology and chemistry in high school. And I knew in college that I was a math-oriented guy. Part of it was all these words, man. It was like, word, is that proper English? Anyway, what is proper is Incyte. Year to date, 52%. Whew, looking good. 5 year, it looks like the market wasn't sure about this stock. Now it's fairly sure. Hey, this thing's good. This thing is good. Let's take a look at what's going on. This is a good sized company at 20.7 billion. Revenues of 4.8 billion. P ratio is 17.85. Forward P of 14. Analysts think it's gotten too expensive. We've got 16 analysts covering it, and they are confused or arguing over the stock price targets. They think it's either worth 125 or 60. Okay. Now, when they put together their forecast on what this business is going to do, the revenue this year has been really good, 19, but it's falling to 10% growth, 9. And it is a pretty good sized company, by the way. That's pretty good growth on a big number. So it's going to be positive growth with an expansion of profits and a lowering of that PE ratio. That looks pretty good. Looks pretty darn good. And when we look at their debt level, they don't have any debt, mostly cash, almost $3 billion of cash with $41 million of debt. So lots of cash on the balance sheet. I'm going to do a back of the napkin valuation on this just to get us kind of in the ballpark. And if they're doing $1.2 billion of free cash flow plus $2 billion of cash, they're probably worth $26 to $28 billion. And their price right now at 21. So there's some upside in Incyte. They have momentum. Now, there's a lot of opportunity in healthcare. I think it's a really beaten down space. This one probably wouldn't make it into my buy list just because I think a lot of the greatness is behind us, and it's probably going to settle down for a while because it's gone up so darn fast. What do you think, Daryl?
Yeah, I've been looking at these for the last couple of days. I'll move over to the chart here in just a second, but for the year to date in the healthcare, there are 5 industry groups, and the top performing has been medical supplies, followed by biotech, which is where this one falls in. So I expect this one to also, for the most part, kind of follow what we saw there, and it's up 88%, so 4 times as much. What might be interesting is let's just drill down into this one and see where the best performing companies are. So you look at 700% on these two, 600% on these two, 500, we get down to 400. So this has been an incredibly performing. Look how far I have to scroll down before I get to any that are even red.
Incredible.
Yeah, so one way to play this is through the ETF IBB. Okay, so I don't know how far I had to scroll down, but that was a long way before I got to anything below. Now there are some that are below. Let me scroll down, but the worst performing is 100%. Compared to the whole bunch we saw at 700 or 300 and up. So this has performed well, not as good as others. So it is on an uptrend, starting to roll over a little bit. We do have an upward sloping 20, 50, and 200. It was overbought when it got here. It has pulled down below the overbought condition. We're getting ready to have a bearish crossover in bullish territory. The accumulation still looks really good, pretty near a 52-week high. So this one definitely is looking good right now, but I see some pressure on it that may be coming through the RSI and the PPO.
Thank you, sir. All right, so I think we've caught up on the request. Thanks, everybody. But with the exception of one, I forgot who asked, but somebody asked about YMM, stock I'd never covered. And this is a Chinese stock, $11.7 billion market cap, revenues of 1.7. And they operate a digital freight platform that connects shippers with truckers to facilitate shipments across distance ranges, cargo weights, types in the People's Republic of China and Hong Kong. So most definitely a lot of production happens in China, and it has to be moved from factory or assembler to either the next factory in the supply chain or to the port to be exported, all that type of activity. This company has a PE ratio of 22.4, forward P 21.7. The 1 year looks decent. 5 year, Chinese stocks have been beaten down, but this one's making it happen for the current year. It has seen a lot of volatility recently. Probably announced today. Yeah. And the market didn't like what it saw. So taking a look at the growth has been good in the stock, but the growth rate really dropped in the quarter they just announced. So I think the market was caught by surprise and sold off the stock. So the growth is really slowing. This is a Chinese stock. It's likely, if you were to use the same fundamental analysis that you would use on an American company, this would be discounted. But Chinese stocks, you have to discount twice. You go, okay, this is the fundamental valuation. And then what kind of additional price deduction reduction do I have to make because it's in China? So good and profitable, margins are good. Okay. Looks good. Now their growth rate surprised. They're going to get into a slower growth rate, although it's supposed to pick up going forward. I think production is picking up in China. I think they're back to 100%. So I think these numbers are going to be good going forward. And this P ratio is going to come down. It's a good idea. This stock's likely discounted and would probably, if you buy it at the right time, right now might be a good time. Let this thing settle down. Maybe buy into it. I own a couple stocks in China. I own Alibaba, Futu, and I own an ETF that buys into Chinese stocks. This one might be a good buy idea, but I don't know. Maybe I've got enough in China, but for somebody who's looking for a good Chinese stock, this might be a good idea. So, what do you think of YMM?
Well, I'm looking. I went back a couple years, and this is a pretty good support level. So I put my crosshairs right where it's trading, where it traded down to today. And that was a good December 2024 level. If it falls below that, then we're looking closer to here. But I think this is actually a pretty good support level. What I am seeing is that you got about a $2 downside if it did break through that and trade back down to these lows from April, and you have about a $2 upside. So the risk reward is not really skewed one way or the other. It's about a 50-50. The 50-day is peaked out and running downwards now, as well as the 20-day. The RSI moved into oversold territory today. The PPO is in bearish territory. The accumulation is pretty much sitting at a 52-week high at the moment. So to me, this looks like a 50% risk reward, and it is at support at the moment.
All right. Thank you, sir. Well, looks like the market's selling off a little bit. Not too bad, close to flat. And if we look at the heat map, there's winners and losers. NVIDIA is settling down. Apple's coming down. Palantir's down. Amazon down. Broadcom, Micron, Google up. Pharma's up. United Healthcare's up. That's good. Utilities are up. Staples are up. So I'm sensing the fear is still out there, right? Staples are catching a bid. Utilities are catching a bid. Hey, this is nice and safe. Collect a nice dividend. Telecom is a little green. So that is interesting. What's causing this rally in Google is the Oracle from Omaha. They released a lot of information on Friday. One of them is their 13F filing. And their 13F filing shows that, hey, they decided to start buying into Google. $4.3 billion worth of stock. And they probably did it over the mobile Robinhood app. They put in how many shares? 17 million shares. Boom. Just kidding. So Apple, they sold off quite a bit of shares, but they still own $60 billion worth, but they sold 15% of their share count. And they kept their American Express. They sold off some Bank of America. Added some Chubb. Insurance, and they already own all of Geico. And then they bought Alphabet. They sold off more of their Davita Health Care Partners, added more Siri. Interesting. I wonder what the play is there. Don't know. VeriSign, they've been getting out of that. I looked at VeriSign. It doesn't look like a good investment to me. And they added some more Domino's. Who needs DoorDash? I'll go straight to Domino's. I'd rather own DoorDash. I've looked at Domino's. Doesn't look like a good investment for me. So we'll see how that plays out. All right. So I think we covered good ground. We covered 7 stocks in detail, as well as Berkshire. And I think today might be a flat day. It's definitely looking that way. And this week, I think the market's kind of going to wait till Wednesday after the market closes to really understand where's this market going, because NVIDIA is going to announce earnings after the market closes. Hopefully Daryl can live stream with me live. We're going to do a watch party, get a hold of those earnings, see what they had to report, see how fantastic their numbers are, and see how the market reacts to the stock, on the stock price based on the earnings. And man, I don't know. I could see it selling off. I'm feeling negative this week. And I'm feeling like, hey, this market's just expensive and needs to give up some of its price in order for it to be closer aligned, closer matched to value. And that's where my head's at. We'll see where the rest of the investing community is thinking. So any departing thoughts, Daryl? Anything going on with your channel that you wanted to make everybody aware of?
Yeah, I did release an NVIDIA earnings preview video yesterday if anyone's interested. So I give my thoughts on what's happened with NVIDIA over the last year and how their valuations look.
Awesome. That looks interesting. Thank you for doing that. All right, everybody. Well, that is our Monday morning live stream. I hope you found it interesting. Again, thank you for the new member that joined and the super chat, all the members coming back and putting up stocks that you wanted to go take a look at. And looks like we got a price prediction out there. NVIDIA is going to go to 260. Where's NVIDIA at now? Whoa, there we go. Yeah, if it goes to 260, that would be phenomenal. We'll see what happens. With that, everybody, have a terrific week and tune back in on Wednesday to watch the NVIDIA earnings watch party. Last time we had 3,600 people on our stream. It's the biggest stream that I've done, and in partnership with Daryl that we've done. And I'm thinking it's going to be probably around the same size of audience, if not bigger, because I think everybody's looking at NVIDIA going, NVIDIA, where are we going? Are we going higher or lower? And I think based on that earnings, we're going to set a course at least for the next 30 days until the Fed decides, are we going to move interest rates higher or lower, or until another major story comes up. So that is what's going on this week. Thanks everybody for tuning in. I wish you the best of success with your trades, and thank you for tuning in. See you guys.
Take care, everyone.